In just 2 days, one man lost $20 billion. Not a bank, not a country. One man, running money out of a small office most of Wall Street had never even heard of. He had quietly built one of the largest fortunes on the planet, an estimated $36 billion at its peak, and almost no one knew his name. Then, over a single spring weekend in 2021, it came crashing down. $20 billion, gone in about 48 hours. And he burned some of the world's biggest banks on the way down. How does a fortune this large simply collapse? To understand it, you have to understand one invisible tool. His name is Bill Hwang. In professional investing, he was almost a legend. In the 1990s, he trained under Julian Robertson at Tiger Management, one of the most respected hedge funds in history. Robertson's best students went off to run their own funds, and the industry gave them a nickname, the Tiger Cubs. Hwang was one of them, but his record wasn't spotless. In 2012, his earlier firm, Tiger Asia, pleaded guilty to wire fraud in a case brought by the U.S. Justice Department and settled insider trading charges with the SEC for around $44 million. He was effectively banned from managing other people's money. So Hwang did something clever. He opened a family office, a firm that manages only his own personal wealth. And here's the key. Because a family office isn't handling the public's money, it faces far lighter disclosure rules. It doesn't have to reveal what it owns the way a normal fund does. It can operate almost invisibly. He called it Archegos Capital Management. The name comes from a Greek word meaning the one who leads the way. He started, as Bloomberg reported, with around $200 million of his own money. On paper, a quiet comeback. In reality, the beginning of one of the fastest rises and most violent collapses in modern financial history. So how do you turn $200 million into $36 billion in less than a decade? The honest answer? Not with savings, with leverage. Leverage simply means investing with borrowed money. Put in $1 of your own, borrow 4 more from the bank, and suddenly you control $5 of stock. When the price goes up, your gains are multiplied by 5. It feels like genius. And for years, for Hwang, it worked. But he used a specific, powerful version of it, an instrument called a total return swap. Here's the idea in plain terms. Instead of buying a stock himself, Hwang asked a big bank to buy it and hold it on its own books. The bank became the official, legal owner. Hwang simply collected the gains if it rose, agreed to cover the losses if it fell, and paid the bank a fee for the service. Why does that matter so much? Because the stock legally belonged to the bank, Hwang's name never appeared anywhere. Normally, a large investor must file public disclosures revealing big stakes. Through swaps, Hwang didn't. As Bloomberg later reported, he built enormous positions that were essentially invisible to regulators, to the public, and even to the other banks. And that is exactly what made it so dangerous. He ran these swaps at several banks at the same time: Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS. Each bank could see only the slice of risk it personally held. Not one of them could see the full combined picture. He poured this borrowed firepower into just a handful of stocks: Viacom CBS, Discovery, Baidu, Tencent Music, and a Chinese education company called GSX. He didn't spread the risk across hundreds of companies. He concentrated it into a few. To give you a sense of the mania, some of these stocks doubled, even tripled, in a matter of months. And Hwang kept pouring more borrowed money in at every step. On some days, as the SEC later detailed, his trading alone made up a large share of the total volume in a single stock. He wasn't just riding the wave. he had become the wave. And a wave that big can never be exited quietly. And as those stocks climbed, the numbers became staggering. According to federal prosecutors, his roughly $36 billion in capital was controlling more than $100 billion worth of stock. His own buying helped push those stocks higher, and the higher they went, the more he could borrow to buy. A machine that seemed to print money. But leverage has a second face. And almost no one was looking at it. Here's the part they don't teach you in the excitement. Leverage cuts both ways. When prices rise, borrowed money multiplies your gains. When prices fall, it multiplies your losses at the exact same speed. And attached to it is a mechanism called the margin call. When your positions fall below a certain value, the bank demands more cash, immediately, to keep covering the loan. If you can't pay, the bank simply sells your positions to protect itself. You don't get a vote. You don't get time. In late March 2021, the trigger arrived. One of Hwang's largest bets was Viacom CBS. The stock had soared, partly on his own buying. Then the company announced it would sell $3 billion of new shares to raise money. That flood of new supply, hitting a market that was already cooling, sent the stock sliding. For a normal investor, a dip like that is uncomfortable. For someone leveraged the way Hwang was, it was fatal. As Viacom CBS dropped, the value backing his loans evaporated. The banks issued margin calls. Hwang didn't have the cash to meet them. According to Reuters, the banks called an emergency meeting, hoping to unwind his positions in an orderly way, to sell slowly and avoid a panic. The talks fell apart. It became every bank for itself. Goldman Sachs and Morgan Stanley moved first, dumping billions in giant block trades. Credit Suisse and Nomura hesitated and paid for it. The fire sale pushed tens of billions of dollars of stock onto the market in a matter of hours. And because Hwang's positions were so concentrated, the selling crushed the very stocks he was most exposed to, which triggered even more selling. A doom loop, feeding on itself. Bloomberg captured it in one brutal line. Bill Hwang had $20 billion, and then he lost it all in 2 days. And he didn't fall alone. Credit Suisse, according to its own internal report, lost about $5.5 billion. Nomura lost nearly $3 billion. Altogether, as tallied by Reuters, the banks lost roughly $10 billion. 2 years later, battered by this and other scandals, Credit Suisse itself collapsed and was absorbed by its longtime rival, UBS. So what does a $36 billion collapse have to do with you? Someone who will never run secret swaps at 5 banks? Everything. Because the trap that destroyed Bill Hwang is the same trap in miniature that quietly wrecks ordinary investors every single year. Here's the principle. Leverage doesn't just increase your risk, it takes away your time. An investor using only their own money can be wrong for years and simply wait for the market to recover. A leveraged investor can be right in the long run and still be wiped out in a single bad week, because the margin call forces them to sell at the worst possible moment, locking in the loss forever. You don't have to be a billionaire to fall into this. It's the exact same physics when a trader buys stocks on margin, goes all in on options, or when a crypto investor uses 10 times leverage and a small dip liquidates the entire account. Borrowed money plus concentration in a single bet. When it moves against you, you no longer decide when to sell. The loan decides for you. And this wasn't the first time history rhymed like this. Back in 1998, a fund whose partners included Nobel laureates Robert Merton and Myron Scholes, called Long-Term Capital Management, used the very same cocktail. Brilliant models, extreme leverage, and total confidence. When the market moved the wrong way, It nearly brought down the global financial system, and according to the Federal Reserve, regulators had to organize an emergency rescue. The names change, the instruments get fancier, the mistake stays exactly the same, and that points to the golden rule this whole story is really about. In investing, it is not what you make that matters. It's what you can survive. Hwang didn't lose because he couldn't pick winning stocks. For years, he picked them brilliantly. He lost because he built a position that could not survive being wrong even once. Diversification, position sizing, and knowing exactly how much you are truly borrowing are not the boring parts of investing. They are the parts that keep you in the game long enough to win. The real fortune isn't the one you build in the good years. It's the one you refuse to lose in the bad ones. Which brings us back to the question we opened with: how does $20 billion vanish in 48 hours? Now you know the answer. Because the $36 billion was never really his to begin with. He had a modest amount of his own money and an enormous mountain of borrowed exposure stacked on top of it. Leverage had made him look richer than almost anyone alive. And leverage, the moment the market turned, took all of it back, with interest. In 2022, United States prosecutors charged Hwang with fraud and market manipulation. In 2024, he was convicted and sentenced to 18 years in prison. The invisible empire didn't just disappear, it became a crime scene. But here's what's fascinating. Leverage itself isn't the villain of every story. There is a man who used borrowed money in almost the exact opposite way, slowly, patiently, with iron discipline, and built one of the greatest fortunes in history, and actually kept it. That story is on the screen right now.